Good morning, everyone. I call this meeting of the NCUA Board to order. In addition to those joining us in the boardroom today, the meeting is open to the public through a live webcast. For anyone watching online, if you would like to view the closed captioning of this meeting, please click on the CC icon located in the lower left corner of the WebEx window. You may also change the layout to one of your choosing by clicking the layout option on the top right side of your screen. Today we observe the 75th anniversary of International Credit Union Day. Since 1948, this occasion has served as an annual reminder of the power of cooperative credit and the global reach of the credit union movement in creating a brighter financial future for people all over the world. When the NCUA hosted the International Credit Union Regulators Network Conference this summer, I saw that power and breadth firsthand. Credit union and financial cooperative supervisors from central banks and agencies in Europe, Latin America, Africa, Asia, Australia, and the Caribbean gathered to discuss the important work they are doing around the world. The event also illustrated that there are people across the globe looking to the cooperative financial system as a solution to building economic and financial security. Today, credit unions are building a better future in places like the United States, but also in places like India, Ireland, Poland, South Korea, Kenya, Brazil, Mexico, and Grenada. Credit unions are also helping people in places of conflict to maintain financial stability during times of uncertainty. The NCUA's work to advance financial inclusion and economic security, I know that's always been of great importance to you, Board Member Hood, is vital to creating a fairer and more equitable financial system that works for everyone. Through our Small Credit Union and Minority Depository Institution Support Initiative, financial literacy initiatives, and fair lending oversight, the NCUA is doing its part to foster greater economic opportunity for historically under-resourced populations across the United States. And our work is contributing to the strength of the global credit union movement. That concludes my opening remarks. Vice Chairman Haltman, I now recognize you.
Yes, sir. I appreciate you bringing it up. 75th anniversary, International Credit Union Day. One thing to note is that credit unions are like a lot of things in this country, that they came to us from abroad. They came to us from international waters, or whatever you consider Quebec, because that's where they came from. The first credit union came from Quebecois immigrants into New Hampshire. If you've ever been to the Credit Union Museum in Manchester, New Hampshire, that credit union's business, back when it operated as a credit union, before it was a museum, was entirely in the French language. And credit unions do things very similar to that today. I know the Ukrainian American credit unions mentioned that 40% of their calls are in the Ukrainian language, customer service calls. Very similar situation to the Quebecois who wanted to do business in French at a time when it was hard to find a place you could do business in French. The cooperative nature of credit unions gives regular people, no matter what their circumstances, the opportunity to own and control their own financial institution with access to a safe place to save money and get secure, affordable loans. People from all walks of life can achieve their dreams. And for many people around the world, it's an unfortunate fact, but it's true. Many people around the world, the credit union will be the only form of democratic control that they have in their life. Please be able to bring awareness to the work of credit unions around the world. And back to you, Mr. Chairman.
Thank you so much. Board Member Hood.
Great, thank you, Mr. Chairman. I join the chairman and vice chairman in wishing everyone a happy International Credit Union Day. I can't believe it's the 75th anniversary. What pleases me most, you all, is the fact that we in the United States, we are fortunate to have 138 million members of our federally insured credit unions. But on the global arena, you all, it's some 375 million folks worldwide who are a part of the credit union movement. I take great excitement in the fact that we now are touching the lives of individuals to give them access to the loans that they need to get cars, for their automobiles to go to and from work, the mortgages that they need for sustainable home ownership, and the loans that those Main Street business owners need to stimulate the economy. On the global stage, just think about it, there are credit unions all over the globe who are doing just that, all demonstrating the ethos of people helping people. While here at NCUA, I've indeed been blessed and fortunate to get to represent our agency abroad, where I get to see some of the other folks at the World Council of Credit Unions, where I've been able to speak recently in Glasgow, the United Kingdom, and most recently in Vancouver, where you all the power of the cooperative nature of credit unions coming together. In fact, just as we are convening here, we at NCUA have a few of our senior leaders who are meeting with the African regulators to help them build their credit union system, which they call their SACOs. So NCUA is not just overseeing our credit unions here, but we are really empowering individuals around the globe to glean insight from some of the things that we're doing. And I'm proud to play a part in what little part I can play, and again, demonstrating people helping people. Happy 75th anniversary.
Thank you so much, Board Member Hood. Now, turning to our agenda, the first item of business today is a board briefing and update on cybersecurity issues. Staff presenting include Ernie Chambers, Director, Critical Infrastructure Division, Office of Examination and Insurance, and Todd Finkler, Cybersecurity Advisor and Coordinator, Office of the Executive Director. This briefing also coincides with National Cybersecurity Month. It seems we are doing a lot of things this month. Good morning, Ernie. Good morning, Todd. And Todd, welcome to the NCUA board table for the first time. Please begin when the two of you are ready.
Sure, yes, sir. Good morning, Vice Chairman Harper, Vice Chairman Hoffman, and Board Member Hood. Good morning. It is indeed my pleasure to meet you once more to discuss the topics related to cybersecurity. Next slide, please. The cybersecurity landscape of the credit union ecosystem is confronting an unprecedented surge in cyber threats with credit unions, credit union service organization, CUSOs, and third-party vendors falling prey to an alarming increase in attacks. An example of this emerging crisis is the impact of the one critical and two high critical vulnerabilities within the Move It Transfer Web application. This vulnerability and its associated linkages led to a series of targeted attacks on financial institutions, jeopardizing the integrity, confidentiality, and availability of sensitive data. The exploitation of the Move It vulnerability is only one part of a successful attack chain. Because of that, we will talk about the cybersecurity benefits and challenges with aggregating services, the trends of attack vectors, the mechanisms to improve our understanding of those attacks on the credit union sector, and data to begin to prioritize strengthening efforts. Our discussion today will cover financial sector trending attack tactics, raising the attack cost for the adversary, NCUA efforts at raising the adversary's cost, the third-party challenge, and information security examination program updates, cyber incident notification reporting, and finally, NCUA cybersecurity resources. Today, I'm joined by Todd Finkler, NCUA's Cyber Advisor and Coordinator, and Todd will handle the first 4 bullet points of the presentation. Next slide, please.
Thank you, Ernie. Good morning.
Good morning.
Chairman Harper, Vice Chairman Hauptman, and Board Member Hood. I'm really excited to be here talking about cybersecurity today. I mean, obviously it's my job, but I think it's super important for the financial sector. In 2023, finance firms lost approximately $5.9 million per data breach, 28% higher than the global average compared to other commercial sectors. To focus our cybersecurity investments activities to prevent these attacks, it is helpful to understand the number and pattern of successful attacks to adjust to the cybersecurity's dynamic. Mike, please move closer to you. Thank you. Sorry. To adjust to cybersecurity's dynamic environment. In the financial sector in general, the most common tactics used in nearly half of successful attacks include simple web application attacks such as guessing weak passwords, using stolen credentials, and trying default passwords on accounts. The second most useful tactic, system intrusions, are normally from the more dedicated cyber criminals and require more skill and effort, but still account for over 1/3 of the successful attacks. They include exploitation of vulnerabilities on web applications, remote monitoring and management software, and email. Coming in at third, human errors in sending the data to the wrong recipient, inadvertently publishing sensitive data, and misconfiguration of network devices are responsible for 1/3 of the successful attacks. Finishing up out the top 4 is social engineering, which includes pretexting and phishing, which still are used 1/4 of the time. It is important to point out that these tactics used across commercial sectors are significantly different. The data I just provided is based on the financial sector. One of the values of the new cyber incident reporting rules is that aggregate attack data focused specifically against credit unions will be available and potentially offer valuable insight into the specific sector. Next slide, please. While we will never be protected from 100% of the attacks, our goal should be to disproportionately raise the cost of a cyber attack for the adversary to reduce the number of cyber criminals able to attack us. Given the trends of successful attack tactics, the following cybersecurity activities offer high-level guidance to mitigate those tactics that significantly raise the cost for the adversary without significant cost for the defender. To mitigate simple password attacks, multi-factor authentication should be enforced. Technical details can be found through the National Institute of Science and Technology. To reduce system intrusions, general guidance can be found at the Cybersecurity and Infrastructure Security Agency's, commonly referred to as CISA, Shields Up program. Additionally, CISA's Known Exploited Vulnerabilities Catalog and Critical and High Common Vulnerabilities and Exposures, or CVEs, prioritizes published vulnerabilities in software and hardware. Timely mitigation of these vulnerabilities is essential because adversaries start to build exploitation against these vulnerabilities on day one of their publication. Finally, test website security through CISA's free automated scanning of external web-facing applications. This service generates weekly reports of vulnerabilities of your web applications and internet-facing devices that help you discover and prioritize your vulnerability management. To reduce human errors and mitigate social engineering, initiate increased skills-based cybersecurity training and social engineering awareness training. Guidance for developing social engineering training can be found through CISA's anti-phishing training program support. In addition to the above, CISA also developed cross-sector cyber performance goals, which provide a list of controls to strengthen your cybersecurity program. What I like about these goals is that you can get an idea of the cost of implementation, high, medium, and low, relative to the level of impact of raising the cost to the adversary. I am excited about a follow-on effort to develop a more refined financial sector goals in the coming year. We have links to all these recommendations on NCUA's cybersecurity resources and reference page. Next slide, please. The credit unions are not alone in their efforts to raise the cost of cyber attacks for the adversary. The NCUA is focused on many activities, including the following highlighted areas. In support of the May 2021 Presidential Executive Order on improving the nation's cybersecurity, we've implemented multi-factor authentication and encryption for data at rest and data in transit. And we are improving our language for our third-party service providers to do the same. We are enhancing the security of the software supply chain and our zero trust architecture. In addition to the executive order, we are aggressively mitigating published vulnerabilities to both CISA's known exploited vulnerabilities as well as the critical and high common vulnerabilities and exposures. The NCUA consistently exercises third-party penetration testing as well as cybersecurity audits. And finally, the NCUA provides regular cybersecurity training and performs cybersecurity exercises to improve our response to social engineering attacks. Next slide, please. Central to the vulnerability landscape is the intricate web of third-party vendors that support the operations of credit unions and their associated entities. These vendors facilitate critical services ranging from payment processing to customer data management to cybersecurity services. In this interconnected ecosystem, a single vulnerability can set off a chain reaction leading to compromised operations, loss of sensitive information, and regulatory noncompliance. Case in point is the most recent MOVEit vulnerability Ernie mentioned earlier, which resulted in the exploitation of over 2,000 institutions and 60 million members, and that number is still growing, allowing threat actors to gain unauthorized access to sensitive financial data impose financial losses, and inflict reputational damage. Credit unions need to maintain an awareness of the potential risk and resulting systemic impact this outsourcing has on our financial system, and it demand these third-party vendors uphold the highest standards of cybersecurity. In addition to the items to raise the cost of attack for the adversary that I mentioned earlier, the following items should be achieved. Develop, rehearse, and define an incident response plan, including roles and responsibilities to facilitate a coordinated response in the event of a breach. Conduct exhaustive security assessments of third-party vendors, gauging their cybersecurity practice and incident response strategies to understand and mitigate the cyber risk they expose. Maintain regular data backups with offline storage, reinforced by recovery testing to minimize ransomware impact. Engage in collaborative threat intelligence sharing networks to remain abreast of threats, emerging threats, and attack trends. And institute continuous monitoring of network traffic logs and systems to promptly detect suspicious activity, swiftly applying security updates and patches. As the credit union industry grapples with rapidly evolving threat landscape, it is the imperative of robust cybersecurity practices remains undeniable. The interconnected nature of credit unions, credit union service organizations, and third-party vendors necessitates a unified response to safeguard the ecosystem. By adhering to best practices, the industry can bolster its defenses, protect the confidentiality of data, and maintain the trust of stakeholders and counter the growing tide of cyber attacks. Next slide, please. If the discussion seemed daunting and you are unsure where to prioritize your cybersecurity resources or even where to start, you can contact your regional CISA cybersecurity advisor who can offer cybersecurity assistance. Cybersecurity advisors can introduce organizations to various CISA cybersecurity products and services, including the ones I mentioned, along with other public and private resources, and act as liaison to CISA's cyber programs. Cybersecurity advisors can also provide cyber preparedness assessments and protective resources, working group support, leadership, partnership, and a public-private development and coordination and support in times of cyber threat, disruption, and attack. An additional high-level resource includes CISA's Shields Up program that I mentioned earlier, which covers broad areas, reducing the likelihood of a damaging cyber intrusion, taking steps to quickly detect a potential intrusion, ensuring that the organization is prepared to respond if an intrusion occurs, and maximizing the organization's resilience to a destructive cyber incident. One final thought. As you may have noticed in attacks on slide 3, people are a critical component of cybersecurity. As more criminal elements from around the world adopt cyber attacks as a means to make money, coupled with our country's adoption of the internet to provide amazing financial services, every one of us becomes an indispensable link in the cybersecurity chain, demanding that we understand our responsibilities related to good security habits. As part of the National Cybersecurity Awareness Month, CISA offers 4 simple recommendations that every individual can perform to raise the cost of the adversary. Use strong passwords. Turn on multi-factor authentication. Recognize and report phishing. And finally, update your software. On that, I will turn it back over to Ernie, who will continue with the information security exam. Next slide, please.
Indeed. Thank you, Todd. That's it. Earlier in the year, we reported out on what we consider a significant leap forward for our examination capability. That being the Office of Examination and Insurance's implementation of the Information Security Examination Program, better known as ICE. Going forward, all credit unions will go through the ICE as part of their overall examination. By way of quick overview, the ICE assessment has 3 primary components: the exam profile, statements, and substatements. The exam profile is the initial step in developing a capability to identify and collect information security and cybersecurity risk indicators. The profile covers activities, services, and products of the credit union. Each statement is a high-level activity, process, or control. Statements are comprised of one or more multi-numbered substatements. There are 3 types of exam-level statements making up the ICE. SCUP statements, which are tailored for credit unions of asset sizes of 50 million and below. Core statements, tailored for credit unions of asset sizes greater than 50 million. And Core Plus statements, containing optional examination elements where specialists may reference based upon risk. Next slide, please. That reorientation out of the way, since its deployment to our field examiners, we have processed just over 1,000 ICE assessments and are now able to begin sharing some general trends and observations, which we view as a real win for our supervised institutions. Strengths. Strengths of our small credit unions from 2023 information security exams, their maintenance and backup and recovery plans for critical systems and services in the event of a disaster or incident was noteworthy, maintaining antivirus and or anti-malware controls, and then patching critical applications and systems, all identified as strengths. Next slide, please. Some recommended suggestions coming forth from our observations amongst the SCUPs are reporting information security risk assessment results to the board of directors, providing test results of key or critical controls to the board of directors, and reporting cybersecurity contract provisions for third-party service providers to their board of directors. Next slide, please. Likewise, strengths of core credit unions. Workstations and servers were receiving their automated updates. They possessed active antivirus, anti-malware alerting mechanisms, and deployed email server anti-malware protections. Next slide, please. Some recommended suggestions. The reporting of information security risk assessment results to the board of directors, providing test results of key or critical controls to their board of directors, and providing third-party service providers cybersecurity contract provisions to their board of directors. Look a little bit familiar. The information security examination is designed to cater to the unique characteristics of an organization's size and complexity. This tailored approach of the ICE ensures that the examination statements are rooted in both regulatory requirements and industry best practices. With that, I would like to turn our attention to yet another major accomplishment of the Office of Examination and Insurance's Critical Infrastructure Division, that being the implementation of the Cyber Incident Reporting Rule. Again, by way of refamiliarization, building upon the need for rapid incident response, the NCUA board approved the Cyber Incident Reporting Rule, mandating that credit unions promptly report any significant cyber incident within 72 hours. These incidents included data breaches and disruptions to member services or operations, recognizing the interconnectedness of the financial ecosystem and reflecting the NCUA's commitment to collaboration and information sharing. The successful fulfillment of the cyber incident reporting capability encompassed several key program elements. It began with establishing a robust regulatory framework, including the NCUA Cyber Incident Notification Reporting Rule, which set the stage for cybersecurity compliance. Technological integration was critical, involving solutions like a dedicated email address and a toll-free phone number for reporting incidents. Comprehensive instructions were developed and resources like a letter to credit union and contact card were created to assist credit unions in their reporting. Webinars for both industry and our NCUA exam staff provided essential information, while the National Supervision Policy Manual was updated to reflect pertinent changes. Additionally, the agency continues to interact with regulatory bodies like CISA to ensure compliance with broader cybersecurity efforts and potentially limit duplicate reporting in the future. Next slide, please. Credit unions can report cyber incidents by contacting the NCUA through 2 means, email and voicemail. The email is reflected in the slide, and the voicemail, 1-833-CU-CYBER. Sir, yes, sir.
I think you are on slide 15. You're on slide 14 right now.
Oh, okay, I'm running through that. My apologies. Please back up one slide.
Can we turn
Slide
this-
13?
It might be 15.
Okay.
Talking about the email address?
Yeah.
Okay.
Yes,
Yes.
15.
Yeah,
What do you want it to be?
there you go.
Okay.
Thank you, sir.
Welcome.
Indeed. So, the reporting can be accomplished by email or voicemail at cucyber@ncua.gov, by email or voicemail at 1-833-CU-CYBER. That's 1-833-282-9237. And that totally sounded too much like a call from a telemarketer, what I just did. Holy smoke. Next slide, please. Wrapping things up, for those seeking comprehensive insights and resources to bolster their cyber resilience, the NCUA's Cybersecurity Resource Center stands as a beacon. This repository of information is a testament to the NCUA's earnest commitment to equipping credit unions with the tools they need to enhance their cyber defenses. From government to private sector resources, the content within this center is a valuable repository for research and informational purposes, aimed at fortifying the resilience of credit unions against the complex backdrop of cyber threats. NCUA encourages institutions to embrace these resources toward elevating their cybersecurity posture and to remember that vigilance is key. For more in-depth information, guidance, and to access the aforementioned resources, we invite you to explore the NCUA's Cybersecurity Resource Center at ncua.gov/cybersecurity. And sir, that brings me to the end of our presentation.
Indeed it does. Thank you, Ernie. Thank you, Todd, for your informative briefing on the many cybersecurity issues confronting the credit union system, the NCUA, and the financial services sector more broadly. It's appropriate that your briefing takes just place before Halloween, as much as what you discussed is frightening and might keep us up at night. All kidding aside, these cybersecurity briefings are an important reminder of the potential for cybersecurity attacks in the financial services industry, including within the credit union system, that it is high and that will likely continue to stay that way and even grow for the foreseeable future. All of us, therefore, must improve our cybersecurity hygiene and practices. As noted in the briefing, the financial services sector, which credit unions are an integral part of, is uniquely vulnerable for two reasons. The first is, to borrow a phrase that you might know, that's where the money is. And the second reason is because the financial services marketplace is one of the most internet-facing sectors in the economy. These two factors mean that bad actors have an incentive to exploit vulnerabilities at financial institutions of all types and sizes for their own gain. That's why the NCUA, along with other financial regulators, the Cybersecurity and Infrastructure Security Agency, and other government agencies are taking part in National Cybersecurity Awareness Month campaign this month. The NCUA's theme for this year's campaign is Stronger Together. That's because our shared responsibility, the NCUA, state regulators, vendors, credit unions, and members to safeguard our systems. After all, cybersecurity within the financial system is only as strong as the weakest link. For its part, the NCUA has made considerable investments in protecting its systems and strengthening its cybersecurity defenses. This year, approximately $13 million of the NCUA's budget is for cybersecurity-related costs. If you include the resources to support the NCUA's information security examination program, maintain the automated cybersecurity evaluation tool, fund cybersecurity grants, and provide training for credit unions, that figure increases to approximately $22 million. That is a good-sized portion of the NCUA's budget, just about 6% overall. On slide 6, we show the costs of not making those investments. And Todd, as you noted, the MOVEit vulnerability affected more than 2,000 organizations and 60 million individuals. Because of its scale, we will likely never know the total cost of the MOVEit vulnerability, but it is likely in the billions of dollars. For many credit unions, especially small, low-income, and MDI credit unions, making cybersecurity investments can be difficult. Thankfully, there are free resources to help. First, I encourage all credit unions to download and use the NCUA's Automated Cybersecurity Evaluation Toolbox, or ACET for short. This tool is an excellent resource, especially for small credit unions and credit unions with limited resources, to understand their cybersecurity preparedness levels. The asset is available at no cost and can be found online at the NCUA's website, as Ernie just noted. Second, Todd, you spoke earlier about CISA and its regional offices and the specialists available to train. I know you went in a little bit, but I was hoping that we could have just a deeper discussion here. What are the resources? I mean, you talked about some software being available that can run scans.
Yes.
For the credit unions. Talk to me about that.
Yes, sir. So, first of all, I'm excited that, so you talked about the importance of cybersecurity. Absolutely. CISA's role, if you look at their mission statement, their role is to lead our country and specifically the critical infrastructure. So in our case, the credit unions, and help them to be able to manage cybersecurity. Cybersecurity is really a beast of a topic because it covers so many different areas. So they offer, I think the most important thing that if you're not comfortable with cybersecurity and you don't know where to go for resources, CISA offers advisors in each of the regions that you should build a relationship with. They provide service for free, right? You could talk to them and ask them questions of, hey, where do I start? Or you could talk to them of, hey, I've got this set up, but I'm struggling a little bit with my resilience and how I do, are there examples and exemplars for resilience playbooks that I can do for incident responses. And so that's a great first step. And then everything else I'm about to talk about, they can also link you to and make sure you have the right resources, available at the time. The second thing they do, and this is one of my favorite things that they just came out with recently, is the government pays for an automated scanning capability through CISA. And you can go and get your web-facing applications and devices actually scanned on a weekly basis, and they provide you with a report. And the thing that I think is so elegant about that, other than telling you and helping you prioritize what the vulnerabilities are, you're basically your door where anybody from around the world can attack you. They offer the capability to actually aggregate that data across financial sectors and then give us very specific information back to what the threats are at the time. So it helps us with that threat understanding and make decisions on that. Additionally, if you're interested in, if you're struggling, and everybody is with phishing, they've got anti-phishing programs that they can help you support and develop those. CISA also has, I think you may remember the cyber security performance goals. I'm really excited about that because it's the next step of managing the risk and be able to prioritize what controls we actually apply for cybersecurity in the network. It helps us understand what value I get from that by raising the cost of the adversary. Two other programs, the Shields Up program is a general program that helps you overall say, hey, here's the general things you're looking to do, and I'm going to categorize each of these activities and controls that you add into these categories so you have a better understanding of what you're trying to accomplish with cybersecurity. And the last thing, as we've mentioned a couple of times, is National Cybersecurity Awareness Month, where they provide a lot of resources for individuals to go in there and help be a part of that cybersecurity team. That concludes my response.
Thank you, Todd, for those insights. My next question focuses on our recent cybersecurity incident reporting rule. And if you could pull up slide 14. Ernie, as you noted, in the first 30 days the rule went into effect, the NCUA received 146 incident reports. Before the rule, we received about 146 incident reports over the entire year. That's really a notable increase in increasing our ability to understand what's happening out in the credit union system. Could you elaborate on the information that we receive from credit unions? How do we often see attacks or incidents across the system and occurring in real time now? Do we have that capability? And how does this new rule help the credit union industry overall?
Certainly, Chairman Harper. I'd be happy to address your questions regarding the information we receive from credit unions and the benefits of the new rule in relation to cybersecurity. The system, sir, captures structured data about cyber incidents, including details on the services affected, attack types, compromise methods, and the impact on credit union operations. This structured data provides us with valuable insights into the nature and scope of each incident. And while we may not classify that reporting as real-time in the strictest sense, it does approximate this capability and provides a valuable first alert advantage for potentially worrisome cyber incidents. A few of the primary benefits include early detection and knowledge sharing. The incident reporting system puts the NCUA in the know early and fosters knowledge sharing and collaboration within the credit union community, in that we can take that reporting when certain trends portend and communicate that out to the sector via our GovDelivery Cyber Advisory product line. Those lessons learned from an incident can then benefit others, creating a network of support. We can also use the data to determine the primary types of incidents being reported and use it to inform where additional training or guidance may be needed. That concludes my response.
Thank you so much, Ernie. My last question is, with this rule in place and implemented, what are we doing next? What are some of the improvements and next steps that the industry might expect out of the NCUA?
Sir, yes, sir. Again, great question. And the next phase for the cyber incident reporting system will integrate a web-based form of reporting. This enhancement or advancement is poised to significantly aid the analytical process and ease the identification of trending information, among other benefits. We expect that it will enhance our capabilities and support the credit union industry by facilitating streamlined reporting, consistent data structure, and enhanced data collection. By providing credit unions with specific fields to input incident details, we can gather more granular information about each cyber event, which will also allow us to use the data to create educational materials for credit unions to help them protect themselves against cyber threats. In summary, the integration of a web form-based capability represents a significant step forward in our efforts to enhance cybersecurity in the credit union industry.
I certainly look forward to working with you as we consider the budget here in the coming months to make sure that we properly fund that and move forward with it. So thank you for that helpful information and a preview of things to come. I also want to thank you for the solid work of you and your team in implementing the Information Security Examination Program. Since the program began this year, as I understand, we have done 1,100 such examinations. Is that correct?
Yes, sir.
The results we are seeing are positive and demonstrate overall that credit unions are taking important steps to secure their data and systems. Unfortunately, the NCUA's ability to analyze and assess the risk in the entire credit union system remains limited. That's because CUSOs and credit union third-party service providers do not have the same level of oversight as bank vendors, as the NCUA lacks the statutory authority to directly examine or supervise these entities. Stakeholders must understand that the risks resulting from the NCUA's lack of vendor authority are real, they are expanding, and they impact us all. As Todd and Ernie reported, more than 60% of the cyber incidents reporting to the NCUA involve third-party service providers, and that was just in the first month of implementation of the new rule. Until this growing regulatory blind spot is closed, thousands of federally insured credit unions, tens of millions of consumers who use credit unions, and trillions of dollars in assets are exposed to higher levels of risk. Moreover, the Government Accountability Office, the Financial Stability Oversight Council, and the NCUA's own Inspector General have all recommended congressional action to provide the NCUA with this examination authority. I agree with these experts. That's why it's heartening to hear more and more credit union leaders understand the value of the NCUA having the same vendor authority as federal banking agencies. During my travels and meetings with credit union leagues and officials, more CEOs and leaders have told me that they see the value and benefits of restoring the NCUA's vendor authority because they cannot manage all of the potential risks and liabilities associated with their vendors. These benefits include credit union access to NCUA examination information when conducting due diligence. Second, there will be fewer requests by the NCUA to credit unions to intervene with vendors experiencing problems. And three, there will be fewer losses to the Share Insurance Fund when CUSOs have problems and have losses that roll onto credit union books, which eventually then roll into credit unions and may cause liquidations. That last point is not theoretical. It has happened. Restoring the NCUA's vendor authority would bolster our national economic security and save time and money in the long term. It's just common sense and good business. This authority would also ensure proper oversight of the CUSOs and third-party vendors poised to capitalize on financial institutions' growing appetite for artificial intelligence and real-time payment services. Plus, from a consumer service standpoint, it will give credit union members the same protection that bank customers enjoy and that they rightly deserve. That concludes my remarks, and I turn now over to the Vice Chairman.
Thank you, sir, and thank you to Todd and Ernie for the presentation. Todd, is this your first time?
Yes, it is.
Doing
Yes,
it? Welcome to the table. I think you're doing quite well so far. There's no question that securing cyberspace is an intimidating challenge. Developing and implementing a tailored cybersecurity plan is key to protecting everyday credit union operations. This task requires vigilance at all levels of the credit union. Everyone, including credit union board members and NCUA board members, have a role to play. Today's was helpful and heartening. During our last update, I congratulated the Office of Examination Assurance for the official deployment of the Information Security Examination, ISE. We're calling it ICE. Is that what we're doing? We now have about 9 months of experience with ICE, and the data is paying off. So there's good news in today's update. I'm encouraged by the level of preparedness that our examiners are finding in all sizes of credit unions. Today's update also outlines additional simple yet significant recommendations to enhance credit union cybersecurity preparedness. I want to stop there, Todd. You mentioned the federal government resource that people can use to test their cybersecurity.
Yes, sir. CISA offers it. It's a Cybersecurity and Infrastructure Security Agency.
What would
offers.
someone Google to find it?
CISA, what is it called? Hold on one second.
CISA cybersecurity tool, they'll probably get there.
CISA, yeah, automated scanning tool. CISA
Okay.
automated scanning tool.
CISA with a C to start?
CISA, CISA, yes, that's
And
correct.
the results of it do not go to the federal government, correct?
The results of it are kept by, the results are in aggregate kept by CISA, so they
Sure.
can analyze cyber threats.
But
and
that's
provide that
millions of
feedback.
data points, right?
That's exactly right. And those specific results with the name of the credit union go back to the credit.
And if there's
union.
true results and issues, no employee of the federal government has any idea.
That's correct.
Right? People,
Matter of fact, we can't get data back from them with specific credit unions.
right, don't trust government to use data wisely. You don't let it have it in the first place. I'm sure many of you have heard the expression, the secret to success is no secret. It's the consistent application of the basics. In the words of Vince Lombardi, it is the blocking and tackling. In the spirit of International Credit Union Day, I'll say Vince Lombardi was a coach in the sport of American football. Blocking and tackling means doing the basics. The expression is American, the lesson is universal. There's nothing particularly difficult about any of these suggestions other than they require continuous focus and execution. Just like with coaching football, proficiency only comes with repeated practice and improvement. So as a reminder, NCUA and FTC are offering a joint webinar. It is a week from today, October 26th, on Protect Your Credit and Identity with Cybersecurity Awareness. That's a week from now. It's a free webinar. It's a resource. Starts at 1 o'clock Eastern. It is free, no registration. Credit unions and regular consumers are welcome to attend that. Finally, I urge credit unions to check out NCUA's Cybersecurity Resources webpage and do it before an attack, since the nature of an attack means you might not be able to use the internet, right? A couple questions here. First off, we do this right now, cybersecurity update, twice a year.
Yes, sir.
We did it in April or so, and then we do it now in October. I will confess, before this job, if you'd asked me what month was cybersecurity month, I would have had a 1 out of 12, chance of getting it right. Sitting where you sit, hypothetically, right? We determine our own agenda. It's like any recurring thing on your calendar. You don't have to do it just because you yourself put it on your calendar. What if you think it would be okay and serve our purposes, your purposes, everybody's purposes? Let's say we did it once a year, and then if there's a significant cyber issue, you think that would serve our purposes?
Is that question
Yeah,
directed to me?
yeah.
Yes, sir. Well, we.
Whoever has to do the work to testify should be answering this question.
Yes, sir, indeed. Well, of course, we serve at the,
Yeah.
at the election.
We're trying to get it right too. Yeah.
Yes.
Remember, there used to be 0 times a year
Right.
that the NCUA did cybersecurity. We're now having it as 2.
Yes.
But there's no reason to do these things if you don't have to. Just a thought, I think maybe once a year, if we want to do it in October, Cybersecurity Month, and then an if-then statement if there's a major issue either at NCUA or at credit unions in general. And to that end, I want to ask this first question, or second question. I want to make sure we're holding up our end. This country and others are rife with government agencies that lecture the public about protecting data, and then those agencies themselves are hacked. How are we doing here at NCUA about securing our own data?
So, sir, I can answer that question. And so I think for us, we spend a good amount of time auditing and assessing ourselves. And I'll say the auditing and assessing because I think that's super important with regard to understanding what you do. I mean, if I'm in the weeds of doing a cybersecurity management, it's hard for me sometimes to see outside to understand and recognize that I'm actually doing a good job or not. So at least annually, if not more, we have people come in from the outside, consultants, to look at us from a third-party perspective to see how we're doing in managing and securing our data. And I think those offer a great deal of benefit to us. I think if you bring up slide 5, please. On slide 5, we talk about, we get into I love your blocking and tackling comment because I think that's really what cybersecurity is. You're never going to get it 100% right, and it's always going to be tweaking it because your network is different than every other network in the world. So you've got to really rely on your own network and build your own program. But we talked on this slide, we already talked on this slide about several things we do to actually up our cybersecurity game. And all these things are related to people, processes, and tools that really continue to strengthen, and then we continue to exercise and assess how we're doing. So I would argue we do a great job at NCUA of protecting our data.
Excellent. I know that regulation in general often hurts the have-nots and helps the haves because they have an easier time complying with it. Either one of you can take this. You think it's fair to say, and I think it is, that this is one of these things that isn't necessarily an extra burden because it is a net time and hassle saver. Earlier in my life, I was unfortunately in charge of an entity's website. I did not do the requisite work to secure it. It then had a hack, and the amount of time and money and effort and embarrassment, I sat there and wished I'd done the basics, I'd done the blocking and tackling ahead of time, and it was an unbelievable fiasco and caused lots of problems. Meaning, doing this sort of cybersecurity work isn't necessarily a regulatory burden, or a burden at all, done correctly. It is a time, effort, money, reputation saver on net. Do you feel that way?
Yes, sir, I do feel that way. And actually, I'd argue even a step further. So not only is it time saving, but whenever you have it, I mean, if you're in a critical situation, I've seen studies on this. If there's an emergency situation and you haven't thought through that emergency, you tend to do the wrong thing in the emergency, right?
Fair point.
And so in this case, if you actually spend the time and think ahead about, how you're going to handle situations, cyber incidents, and how you're managing your cybersecurity, then you could do it in a calm way that you actually get a better result overall when that incident actually does happen. Because I think you and I, sir, have talked about this before. It's going to happen.
Oh, yeah.
It's not a matter of whether you're going to get attacked. It's a matter of when you're going to get attacked.
And my last question, at our last one of these updates we did here at this board table, I mentioned trying to make it easy for credit unions to comply. Obviously, the easier you make a regulation to comply with, the more people comply with it. And you don't get in trouble for something that didn't even exist before, which is not complying with the regulation, which didn't exist prior to this year. What I'm referring to is we passed a rule that all credit unions have to apply us of major incidents, serious incidents within 72 hours. And I asked for some sort of cheat sheet, wallet card. I've been sent it today. This was, just to be clear, this was sent to all 4,000 and changing credit unions in the United States, right?
Absolutely.
And it was sent to the same email address that we use for other correspondence.
Yes, sir.
So if somebody doesn't have it, in your inbox, it'd be this PDF, correct, attached? You can also reduce it to wallet size. Again, the easier it is to comply, the more people comply. And it's got that number, 1-833-CYBER-CU.
Yes, sir.
I assume somebody else had 1-800-CYBER-CU. And
That's what we got, sir.
Yeah.
So, yeah.
CYBER-CU,
Yes,
Cyber Columbia University or Cucumbers or something. Yeah. All right. And if I was credit union, I would have this physically taped to my home computer, work computer, if I was the person in charge of this, or you can make it a wallet size. The reason I mention a physical object is in this scenario we're talking about, maybe your internal internet is down.
Yep.
Maybe you have a virus on your computer. So you can use a telephone. There's a couple ways to do it. And again, that's why I would tape it out. So in that scenario, you're like, oh, wait, where's that email? Let me find it on NCUA's webpage. Well, maybe I can't do that because my internet's down, right? Let me find that email from NCUA. You might not be able to do that either. So I would make it very simple. I think it's one of those things, what's the expression, an ounce of prevention is worth a pound of cure.
Yes, sir.
In the interest of International Credit Union Day, we can also say a gram of prevention is worth a kilo of cure. Back to you, Mr. Chairman.
Sir, yes, sir.
Thank you. But the quote was Ben Franklin, and your discussion about the information security examination. You bring out the best in me. You got me going with Ice Ice Baby. But if you think about it, what this is about today and what you're talking about is stop, collaborate, and listen. That's what we're doing. And I know it's a little bit funny to make, but it's a serious point that it's what we need to do, what we need to do together.
Any more dad jokes, it's not the place for those. Maybe keep those in your database.
Fair. Board Member Hood, I know that you began these cybersecurity briefings during your time as the NCUA board chairman. It was and still is a good idea, so I thank you for committing us to shine a light on some cybersecurity issues on a regular basis. Please begin.
Great, thank you. But before we begin, Mr. Chairman, I understand that just a few miles from this very boardroom, the Senate Banking Committee is considering the nomination of my successor, Tanya Atsuka, at this very moment. I want to offer her my sincere congratulations on her nomination to the NCUA board and wish her the best during the confirmation process. I also want to welcome our visitors from Ohio who join us today on the front row. Welcome to the NCUA board meeting. Now, to the item before us today. Thank you, Ernie. Thank you, Todd, for representing us, I guess, with not only Cybersecurity Awareness Month, but for your presentation this morning as well. As I've said many times, and I know my fellow board members have said it as well, I too am deeply concerned about cybersecurity. In fact, it's the one matter that often keeps me awake at night. Often say that we as prudential regulators can mitigate a lot of risks, such as interest rate risk, credit risk, balance sheet risk, but cybersecurity breaches are difficult to mitigate once systems are penetrated. Today's briefing underscores a clear message. The landscape of security threats is constantly evolving, and complacency is simply not an option. It's imperative for credit unions and the NCUA to remain vigilant and prepared. Given the current geopolitical climate, which has, quite frankly, only gotten more turbulent since the last time we had a cybersecurity briefing here in April, the risk associated with cyber warfare has surged. Moreover, as financial technology tools become more pervasive, integrating seamlessly into the fabric of our financial operations, our exposure to threats amplifies. However, there's a silver lining. As these threats grow, so does our capacity to thwart them. Now, gentlemen, I do have a few questions. Based on today's briefing, not only at the board table, but when we met earlier this week, the theme seems to be the same for credit unions of all sizes regarding credit unions' cybersecurity risk assessments and presenting this information to the credit unions' boards of directors. My concern is not only that credit unions aren't providing these materials to their boards, but also why aren't the credit union board members asking for these items from credit union management? So question, should we consider sending a letter to credit unions on this matter to ferret out more board engagement?
Sure, I'll take that question, and great question it is. The ICE data will provide us, sir, with insight into many different training areas for credit union and examiners. As more examination data becomes available, we will learn yet more about areas that need improvement and consider how best to provide that additional guidance, including training webinars, web resources, and written guidance. Specific to governance, there exists general training for boards of directors related to governance in the learning management system. That concludes my response.
Great, thank you. I just hope it's something that's ongoing. And again, we need to really ensure that the boards of today's credit unions are really up to the challenges of mitigating a lot of the risk associated with cyber. I know the NCUA is subject to audits in cybersecurity and information technology, and our staff does other reviews as well. What are some of the areas for continual enhancement identified by the most recent audit?
I'll take that one, sir. So it's a great question. I mentioned earlier for the vice chair's response that I love assessments, right?
Mm-hmm.
So we get assessed on a regular basis here at NCUA, and that gives us an insight into kind of an outside view of how we're doing, and may help find the gaps that we haven't been addressing and correct. And so as we were talking to the vice chairman also, this is a long-term game. So, so we definitely need to do those. So in this year's assessments, we actually got managed as managed and measurable, which is an effective status, and that's where we were looking for. That was our goal. So that's a great thing for us to do. Specifically, probably the two largest topics that were in this assessments over the last 2 years that folks thought we needed to improve on is one is vulnerability management. And that's really not a huge surprise because if you look back in, like for example, if you look back in 2021, there was about 350 vulnerabilities published every week, and now it's up to 450, and that trend is continuing to grow. And so because of that, them saying, hey, you need to figure out how to do a better job managing and staying on top of this growing number of vulnerabilities, that was an important finding. And we've been working on that. The second piece of it is related to, and I'll group it together up on the executive order. If you could bring up slide 5 again. It brings up some of the topics that was also brought up in the assessments that we need to improve upon. And a lot of it's, people might call cyber hygiene, but it's stuff like, making sure that everything is encrypted, whether it's in transit or data at rest. It's always encrypted, so if a bad guy gets access to it, they don't have an easy job figuring out what it is. They have yet one more step, one more cost that we're going to add to them. The second thing that I'll highlight there is looking at the other things of multi-factor authentication, the simple things of as we move to the cloud, let's start thinking about securing the cloud. Securing the cloud is different. It's a different system than what we're used to when we have on-prem services. And so this allows us to start saying, okay, what do we need to do? How do we need to strengthen our security in the cloud? And that concludes my answer.
Great. Thank you for that very robust response. And I know we added several new cybersecurity positions during the mid-year budget. Can you please discuss why this was done and if it was largely done because of the aforementioned cyber assessment?
Yes, sir. I'll take that also. And first, thank you for the board for approving those increased resources. I mean, I came in from being concerned with the financial sector in particular, just because of our exposures to challenges around the world. And so, to me, figuring out what those, taking the advantage of those assessments and then leverage them and try to figure out how we respond to that is really the game here. So, for those resources you increase, they go to the first thing I talked about was vulnerability management. So that's one area where we're applying the resources. And the second topic is that as we move a large majority of our work into the cloud, we really want to do a good job of creating a secure architecture for that movement. And that's the second area that covers those resources and where they're going to be applied.
Very well. I think it's wisely applied. I guess I would just note that finding cybersecurity professionals can be really daunting in today's environment. It is truly and undeniably a war for talent. So I hope that you all can work with our HR folks to really have a strategic plan in place around finding the ideal candidates. I've been hearing you all at different programs with some of the community colleges and others that are starting an accreditation program. So it may even entail working with some non-traditional recruiting sources to really fill talent. And again, I think it's definitely something that we want to marshal our resources in the right direction, and glad to know that the budget will allow you to do just that. With that being said, I have no further questions, but I will say, yes, while we are actively talking about Cybersecurity Awareness Month in October, it's something that we all should be thinking about 12 months out of the year, and I know we all are doing that. But I want to say, yes, it's nice to highlight it, but you know what? The 11 months, because the bad actors don't take a pause.
Yes, sir, they don't.
Absolutely. And certainly, your idea about working to provide credit unions with the communication, I think, is a good one. And staff will work to find the appropriate way to do that. That concludes our cybersecurity update. Thank you, Todd. Thank you, Ernie. The second item on our agenda today is a notice of proposed rulemaking, Part 745, Simplification of Insurance Rules. We have two staff from the Office of General Counsel presenting. They are Ian Morena, Associate General Counsel, and Rachel Ackman, Senior Staff Attorney. Also joining them is a regular guest to the NCUA board table, Rita Woods, Division Director, Consumer Access, Office of Credit Union Resources and Expansion, who will be available to answer any questions we might have about these matters. Good morning, Ian. Good morning, Rachel. And good morning, Rita. You may begin whenever you are ready.
Good morning, Chairman Harper, Vice Chairman Hopman, Board Member Hood. We're here today to present a notice of proposed rulemaking that would amend Part 745 of the NCUA's regulations governing share insurance. The primary intent of the proposed rule is to simplify the NCUA share insurance coverage rules related to trust accounts. Before I turn it over to Rachel to get into specifics about the proposed rule, I'm going to give a little background on how the Federal Credit Union Act addresses share insurance and a general description of the current share insurance rules. Under the Act, the NCUA is responsible for paying share insurance to any person with funds lawfully held in a member account in the event of a federally insured credit union's failure, up to the standard maximum share insurance amount, which is currently set at $250,000. In general, the Act is not prescriptive on how the share insurance process works, but it does direct specific treatments for a few types of accounts. For example, accounts held by government depositors and certain retirement accounts. Otherwise, the Act gives the agency substantial discretion. The NCUA has implemented share insurance regulations in Part 745, as I referenced before. Generally speaking, the NCUA determines whether a member account is insured by grouping particular categories of accounts held by a member, such as single ownership, joint ownership, revocable trust, and irrevocable trust accounts. If an account meets the requirements for a particular category, the account is insured up to $250,000 separately from shares held by the member in a different account category at the same federally insured credit union. For example, provided all requirements are met, shares in the single ownership category will be separately insured from shares in the joint ownership category held by the same member at the same federally insured credit union. I'll now hand it over to Rachel to discuss specifics of the proposed rule.
Thanks, Ian. The share insurance process is fairly straightforward for most type of accounts. One exception, however, is trust accounts. The NCUA's current regulations recognize two different insurance categories for funds held in connections with trust: revocable trust and irrevocable trust. The rules also include additional complexity related to the number of beneficiaries that would receive funds from revocable trusts and whether irrevocable trust includes certain contingencies. Despite previous NCUA efforts to address confusion related to trust accounts, the NCUA has received approximately 6,500 share insurance questions related to trust accounts in the last 4 years. Additionally, the complexity also causes a potential for delay insurance payouts when the NCUA has been appointed as liquidating agent. The FDIC, which has deposit insurance coverage rules that are similar to NCUA's rules, has experienced similar issues related to its rules on trust accounts. The proposed rule would make several changes to simplify the treatment of trust accounts. First, the proposed rule would create one trust accounts category. This new category would include informal revocable trust accounts, such as payable and death accounts, formal revocable trust accounts, and irrevocable trust accounts. The proposed rule would also treat irrevocable trusts like revocable trusts, and the fact that contingencies would no longer impact potential coverage. While the change would create simplicity, as all trust accounts, regardless of legal form, will be treated the same, it has the potential to reduce share insurance coverage, as the previous complexity provided the potential for increased coverage. The proposed rule may result in reduced coverage for members who have had both revocable trusts and irrevocable trusts to the same beneficiaries. However, for other members with irrevocable trusts, the proposed rule could result in increased share insurance coverage, as irrevocable trusts with contingencies to multiple beneficiaries will now have greater coverage. Second, the rule would simplify the treatment for shares held in trust with more than 5 beneficiaries. Under the proposed rule, additional share insurance coverage would not be provided if a member leaves trust funds to more than 5 beneficiaries, and this is regardless of the number of trusts used. Again, this change streamlines the rule, but has the potential to reduce share insurance coverage for certain members. The proposed rule includes a question on the potential effect of this change. While we do not believe in practical terms that this change will have a substantial effect on the share insurance coverage for most members, we have specifically asked the question in the proposed rule to welcome further insight about the potential effect. Therefore, under the proposed rule, the calculation of insurance coverage for trust accounts would be similar to the rule currently used for revocable trusts with 5 or fewer beneficiaries. An account holder's trust accounts will be insured in an amount up to $250,000, multiplied by the number of trust beneficiaries, not to exceed 5. This is regardless of whether the trust is revocable or irrevocable, and regardless of contingencies or the allocation of funds among the beneficiaries. This would, in effect, limit coverage for each grantor's trust accounts at each federally insured credit union to the total of $1.5 million. This proposed rule creates more parity between the NCUA and the new trust rule adopted by the FDIC that will be effective in April 2024. While the FDIC final rule has additional details that are included for some specific types of trusts not discussed in the NCUA's rules, the proposed rule would generally be substantially identical to the FDIC's approach. The proposed rule would also make a few other changes in addition to the simplified approach to trusts. The proposed rule would clarify the coverage provided to mortgage servicing accounts for funds that the mortgage servicer or another party deposits on behalf of the borrower. The NCUA's current rules include a separate insurance category for mortgage servicing accounts that are comprised of principal and interest funds. The current regulations, however, do not address funds paid into a mortgage servicing account by someone other than the borrower. By not treating funds deposited by the servicer the same as funds deposited by the member, the NCUA's current rules result in inconsistency and the potential for instability during periods of economic stress. The proposed rule would clarify that these funds receive similar share insurance treatment. This is identical to the treatment under the FDIC's recent final rule. The proposed rule would also make some changes to the NCUA's record-keeping regulations for share insurance coverage. These changes are favorable to members and provide more flexibility to the NCUA to include additional documentation evidencing the intent of the account when making a share insurance determination. These changes would bring the NCUA more in line with FDIC's existing regulations, but would pose no additional burden to the credit unions. Finally, the proposed rule would also remove the appendix, which includes share insurance examples, in favor of updating the Your Insured Funds brochure. That concludes our presentation, and please let us know if you have any questions.
I think you can bet we'll have a few questions, Rachel. Thank you, Rachel and Ian, so much for your briefing and in bringing this proposed rule to the board table today. And although he is not here, I understand that Tom Zels was instrumental in developing this rule as well. And thank you, Rita, for joining us at the board table. Additionally, thank you to staff from the offices of the Chief Economist, the Credit Union Resources and Expansion Office, Examination and Insurance Office, General Counsel, Consumer Financial Protection, National Examinations and Supervision, as well as staff from our NCUA's Asset Management and Assistance Center and our 3 regional offices who worked together on this proposal. This interaction and consultation across the NCUA organizational structure has broken down silos and produced a better rule. So thank you to everyone involved. Deposit insurance at federally insured credit unions and banks is a cornerstone that secures the foundation of our nation's vibrant credit union and banking systems. The confidence created by knowing that savings are protected by the full faith and credit of the United States allows consumers to rest easy, knowing that their hard-earned nest eggs up to a limit of $250,000 will be safe even during periods of financial and economic stress. We saw concerns that came up just earlier this year with the collapse of Silicon Valley Bank, Signature Bank, and First Republic. Between March 13th and March 30th, website traffic to the Share Insurance Fund information pages found on ncua.gov and mycreditunion.gov increased 24% and 77% respectively. And the NCUA's Consumer Assistance Center, along with the Office of Credit Union Resources and Expansion, received more than 6,300 calls from credit union members and consumers with questions about their share insurance. That was more than a 100-fold increase, as I understand, which we would typically field over that point in time. The NCUA's team did a great job in responding to those questions and providing consumers and the public with the needed assurances that their money is safe. And let me just emphasize this. No one has ever lost a single penny of insured shares at a federally insured credit union. We're doing our job, and we're going to continue, and I know the board stands absolutely united to make sure that we continue to make that. That said, we should look to how we might improve our share insurance fund. To maintain this vital information of our, to maintain the vital fortification of our nation's financial system and ensure a level playing field for credit unions and banks to compete, the federal insurance coverage by the NCUA and Share Insurance Fund and the FDIC's Deposit Insurance Fund should align to the extent possible, the greatest extent possible. The proposed rule before us would therefore make changes to the provisions for trust accounts and mortgage servicing accounts to bring these two separate deposit insurance systems into greater alignment. The FDIC, as you noted, adopted these changes last year. Also, Rachel, as you noted, this proposal would simplify the NCUA's insurance regulations by establishing just a single category for trust accounts, which is going to make everybody's life a lot easier. I understand that there's been a lot of confusion related to these accounts over time. And Rita, your office has had to spend, I don't know how countless hours trying to walk through the maze that we've created for ourselves. Let's simplify it. Let's make it easier. Second, we're going to also provide consistent treatment for mortgage service accounts when it comes to principal and interest obligations of the lender. That's good for the consumer as well. And then we're applying more flexible record-keeping requirements, which really is for the benefit of the consumer. Those changes are good changes, and I will support this rule. Nevertheless, as I indicated earlier, Rachel, I do have a few questions for you. It has been the agency's goal to verify member shares and pay out those accounts when we have a liquidated credit union within 3 to 5 business days. How will this proposed rule affect and improve? I'm hoping that you might provide a little more detail, the agencies to meet that goal.
So thank you. We spoke to AMAC, and they believe that in most cases, the changes will not materially impact the agency's payout of shares in liquidation. However, there are some complex trust structures that requires AMAC to gather extensive documentation and work closely coordinated with OGC together to make a share insurance determination. In those cases, the proposed rule could reduce a potential delay in the completion of a share insurance determination.
Yeah, I know that when IndyMac failed, the FDIC, IndyMac specialized in trusts, and the FDIC had to spend months upon months working to resolve those. Certainly, it's in the best interest of everyone involved to quickly pay those accounts out, and it will make people's lives easier, even though credit unions currently are less likely to have a trust account per se. That may not always be in the future. There may be an increased number of trust accounts. Am I correct on that?
Yes.
Great. My next question involves the potential effects on state law. Rachel, will these changes have any effect on state law for trust accounts?
No, these changes, they only impact NCUA's regulations related to share insurance. There would be no impact on state trust laws.
So we're not stepping into the role of the states. States are traditionally where we have our trust laws. That's very good. Finally, my next question is on the issue of pre-existing exemptions and whether they will, if this proposed rule is finalized and drafted, continue in effect. You know, it's when you have a system where things over here are under one set of rules and then things over here are another set of rules, it only creates confusion. Are we going to be making things into alignment here?
Yes, we are. So there will be no pre-existing exemption.
Yeah.
Like you said, doing so can result in greater complexity. You would have 2 sets of rules to implement. And
Right.
the purpose of this rule is to reduce complexity. That being said, we do ask about the potential of a delayed implementation date.
Sure.
So people have time to adjust. And we also asked a question on whether there should be a pre-existing exemption, something for commoners to comment about.
That's great. I think those are important things to do, so thank you for including those. And certainly, I know that the FDIC gave about 2 years to come in compliance. When we finalize this rule, I suspect that we will have a similar situation, all 3 board offices agreeing on that, of course. Lastly, although it's not in the proposed rule, it's my understanding that it'll be easier for the NCUA and federally insured credit unions to verify insured shares at credit unions under this proposal. You know, one of the remarkable things when we went through the banking liquidity crisis earlier this year was the fact that when we looked at it, more than 91% of shares at federally insured credit unions were insured. That is a tremendous number when you think about it. And we recently ticked up to 92%. If we finalize this rule, might we see just a little bit more growth in that? And those numbers are in the exact opposite of what we saw at those 3 institutions that failed, that had more than 90% of their shares uninsured.
So we currently have limited information, and this is one area where I think the comments will be especially beneficial.
Okay.
And we have solicited comments, so hopefully we'll get good comments on that in the proposed rule.
Great. Thank you, Rachel. And again, thank you for your solid work on this proposed rule by you and the rest of the NCUA team. In closing, this proposed rule gives credit union members and members of the public who use trust accounts for the transfer of ownership of assets the same level of protection, whether the accounts are maintained at a credit union or at a federally insured bank. That's just good public policy. That concludes my remarks, and I recognize the Vice Chairman for any comments or questions that he might have.
Thank you, sir, and thank you for the team presentation. Rachel, thank you for filling in for Thomas Zells, and also shout out to him. As I understand it, Thomas is a principal author of this rule. Obviously, deposit insurance is something that affects every single member of a federally insured credit union. As a cooperative fund, our share insurance fund is chiefly made up of the 1% deposit by credit unions. Although deposit insurance is top of mind for consumers and financial institutions following the demise of Silicon Valley Bank that the chairman mentioned, this rule is not a reaction to that effect. It would be in the works regardless of what happened there. However, the issues surrounding Silicon Valley Bank highlight how important deposit insurance is to consumers. The chairman mentioned the massive uptick in calls we had about, is my money safe? And I know NCUA staff had to get pulled away from their regular jobs to go fill in and answer the phones during that very strange period of time in this past March. The sheer volume of questions in general points to a need for simplification. And one of the only products that we produce, sort of, here as an agency, regulations. Clear regulation is good regulation. Language that's confusing or lacking clarity is subject to misinterpretation by entities and consumers. Trust is lost in confusion, and ultimately the consumer would wind up suffering. And although the proposed rule is an effort to align it with those of the FDIC, I'm aware a significant amount of work went into tailoring this for credit unions. Credit unions are different than banks. I appreciate the effort there. I'll say this rule simplifies several complex issues. First, it takes the rules for coverage for revocable trust and irrevocable trust, which currently are different, and replaces them with one rule. Second, the rule clarifies coverage amounts. A member's trust account will be insured for up to $250,000 per trust beneficiary, up to 5 beneficiaries, regardless of whether that trust is revocable or irrevocable. And this is regardless of contingencies, the allocation of the funds among the beneficiaries. This will provide deposit insurance of up to $1.25 million per member per insured credit union for trust accounts. Credit unions contemplating estate planning as something they may want to offer to members. This simplification of rules may make that process more easier to do. Third, the proposed rule is intended to facilitate faster deposit determinations and payouts. Under the current complicated rules, the review of trust accounts is detailed, it's time-consuming. This proposed rule should help streamline this process and get folks paid in a timely fashion. And I definitely look forward to the comments from stakeholders. We want to make sure we get this right. The time to comment is before the entity moves, before this agency moves any further. A couple questions. One, can we just go back to the beginning? What is the genesis of this rule? How did we wind up here?
So first, this rule is not the result of a statutory change. It came about in part because of the amount of questions the NCUA had received about trust accounts. The NCUA also had concerns about timely payments and liquidations from the complexity of the current rules on trust accounts. So these were the main concerns that led to the rule. But another piece was that the FDIC had the same experiences with questions on their trust accounts, and they addressed them through their recent rulemaking, which is effective in April 2024. So that also contributed to the creation of the rule.
Thank you for that. I know, all this makes me think is that, I don't know, someday I would like to either have a trust or be a beneficiary of one, of any dollar amount, but no, this is good work to simplify. Simple regulation is good.
Consistent with our ethics rules, I may be able to find a way one day to make that happen.
Back to you, Mr. Chairman.
Thank you so much. Board Member Hood.
Thank you, Mr. Chairman, and I also want to thank you, Rita, Ian, and Rachel for joining us today at the board table, and also Tom Zells for really all the hard work he and our many other NCUA colleagues played in bringing this rule before us. Under the Federal Credit Union Act, the NCUA is mandated to provide share insurance to members or anyone with funds legally held in a member account should a federally insured credit union fail. This is up to the current standard maximum share insurance amount of $250,000. You all, it was about 12, 13 years ago, I sat here at this board table when we raised that limit from $100,000 to $250,000. So I see many of you remembering that. The Federal Credit Union Act dictates that the net share insurance amount will be determined based on the board's regulations. It also states that all accounts a member has in the credit union, either under their name or others, will be combined to determine this amount. The Federal Credit Union Act permits the board to clarify the scope of share insurance coverage for various account types, including those of minors, trust, and joint tenancy. Today's proposed rule aligns the NCUA with FDIC updates concerning trusts. Share insurance is generally straightforward, but as we've learned through today's briefing, trust accounts introduce complexities. Factors like the nature of the trust, whether it's revocable or irrevocable, all play a role. Given that the FDIC took years to finalize its rule, feedback on this matter is keenly awaited from our stakeholders. In that regard, I just have a few quick questions. Over the past 4 years, how many queries related to trust accounts specifically regarding share insurance coverage have been received by NCUA? I know we heard that there was thousands regarding the bank matter, but what about just related to this trust account?
Sure, yes, I can take that question. We've had, over the last 4 years, CURE has had 6,500 trust-related share insurance questions.
Wow.
Yes.
I find that, well, again, this is a step in the right direction, and I hope that that can clarify that. But when you shared that with me during the briefing, I went wild in. I mean, because that really is far larger number than I ever imagined. Can you all please provide some examples of inquiries that highlight the intricacy of the current share insurance system concerning trust accounts?
Yes, I can take that question as well. So, of the 6,500 trust-related questions from both credit unions and members, we often get questions about how to calculate the amount of share insurance for revocable trust accounts. This can be especially complex when there's more than 6 named beneficiaries in the trust, and each beneficiary has unequal interest. That is, they receive different amounts. In such cases, the revocable trust is then in such cases, the revocable trust is insured for a greater of the sum of each beneficiary's actual interest up to $250,000 for each named beneficiary. This proposed rule, though, will eliminate this complex formula for revocable and irrevocable trusts by simply insuring each beneficiary for $250,000 up to a maximum of 5 named beneficiaries, regardless of whether the beneficiaries have unequal interests. This would provide coverage up to $1.25 million per grantor of a revocable trust account held at the same credit union.
Great, thank you, Rita. And I do all just have one final question. If and when this rule is in fact finalized, what's the strategy for informing the public about these changes? Is there a training plan, outreach plan, FAQ?
Yes, I can take that question as well. So we will communicate the changes to the public through a series or several mediums, such as a letter to credit union, a series of webinars, FAQs, as you just mentioned, and certainly we will update the Your Insured Funds brochure, as well as the Share Insurance Estimator. We'll also make sure that all the materials on mycreditunion.gov is also updated.
Very well, that's very helpful. So thank you for that. I have no further questions, but I will say that much like the chair, but whenever I have any public engagements, I am talking about the strength and vitality of the NCUA Share Insurance Fund. Immediately following the Silicon Valley Bank, First Republic, and Signature Bank debacle, a lot of the credit union folks at some of the convenings, whether they be senior leaders or members themselves, were really concerned and borderline anxious about the state of their credit union accounts. I've been really able to let them know that no one has ever lost a penny of an NCUA insured account. And again, it was just us continuing as board members to echo that sentiment throughout the industry. And even now, I still get a number of questions regarding how safe is it? And again, no one has ever lost a penny of an NCUA insured account. So with that being said, I'm glad to know that there will be PR and outreach if and when this rule does materialize. But until then, I know my fellow board members are continuing to share that story about the strength and vitality of the National Credit Union Share Insurance Fund. Thank you, Mr. Chairman.
Absolutely, thank you so much. And I know this is of interest to you. By simplifying our rules, we're going to be decreasing the number of calls that come into CURE to ask about trust accounts, which means they can increase the resources spent on new credit union charters, as well as field of membership changes that credit unions are requesting. So I think that's important. Vice Chairman Hauptman, is there a motion?
Yes, sir. I move that the board approve notice of proposed rule, Part 745 of NCUA's Rules and Regulations for a 60-day comment period as attached to the board action memorandum.
Is there a second to the motion?
Second.
There is a sufficient second. All those in favor say aye.
Aye.
All those opposed say nay. The ayes have it, and let the record show that the motion passes 3-0. Thank you, everyone. And that concludes our discussion of the notice of proposed rulemaking, Part 745, Simplification of Insurance Rules. The third and final item on our agenda today is proposed rule, Parts 701, 741, 746, 748, and 752, fair hiring and banking. The only person presenting is Pamela Yu, Special Counsel, Office of General Counsel. Good morning, Pamela.
Good morning.
It's always good to have you at the board table.
Nice to
You may
see-
begin.
Thank you. Nice to see you all. Good morning, Chairman Harper, Vice Chairman Hauptman, Board Member Hood. I'm presenting today for the board's consideration a proposed rule regarding Section 205D of the Federal Credit Union Act. Section 205D prohibits, except with the prior written consent of the board, any person who has been convicted of any criminal offense involving dishonesty or breach of trust, or has entered into a pretrial diversion program in connection with such offense, from participating in the affairs of an insured credit union. Just by way of brief background, in 2019, the board issued IRPS 19-1, which we also refer to as the Second Chance IRPS, to provide direction and guidance to federally insured credit unions and individuals who may be affected by Section 205D by describing the actions that are prohibited under the statute and establishing the procedures for applying for board consent on a case-by-case basis. Last year, on December 23rd of 2022, the Fair Hiring and Banking Act was signed into law and became immediately effective. The Act amends Section 205D to expand employment opportunities for those with a previous minor or older criminal offense and makes parallel provisions to Section 19 of the Federal Deposit Insurance Act. In addition, the Fair Hiring and Banking Act specifically requires that the NCUA and the FDIC consult and coordinate to promote consistent implementation of the law. Under that direction, the NCUA developed this proposed rule in coordination with the FDIC. The FDIC will soon be proposing its own parallel rulemaking to amend its own regulations regarding its Section 19. We also consulted with other federal banking agencies to identify common interpretations and areas for cooperation. The Fair Hiring and Banking Act amends Section 205D by, among other things, excluding certain older offenses from the scope of Section 205 prohibition, based on the amount of time that has passed since the offense occurred. So generally, if it's been 7 years or more since the offense occurred, but 5 years or more if the individual was incarcerated, and then it's 5 years from the time of their release, or 30 months since the sentencing occurred and the offense was committed when the individual was 21 years or younger. The new law also excludes certain expunged, sealed, and dismissed offenses. It also excludes certain de minimis offenses, including specific designated lesser offenses, such as passing bad checks, the use of fake ID, shoplifting, trespass, fare evasion, and driving with an expired license or tag. It also designates certain criminal offenses as not involving dishonesty, so therefore it'd be outside the scope of the rule.
Sure.
For example, older misdemeanor convictions and convictions involving possession of a controlled substance, those will be carved out from that definition. Finally, the Act amends Section 205D by specifying standards for NCUA's review of applications for board consent. For instance, the NCUA must make Section 205D consent application forms and instructions available on NCUA's public website, accept individual and credit union-sponsored applications through its regional offices, rely primarily on a criminal history record obtained from the FBI, which we call the FBI rap sheet, in considering the applications, and in a case where there's an application that is denied by a regional office, the statute requires the general counsel review it and certify that it's in compliance, and requires that the applicant be provided an opportunity to request review by the national office of the board. So there is that extra review process. Essentially, in passing the Fair Hiring and Banking Act, Congress codified a number of elements already contained in IRBS 19-1, but also extended greater relief than in what is currently available for individuals with a past record who are interested in working at a federally insured financial institution. This proposed rule would add a new part 752, to the NCUA's regulations to incorporate the agency's current policies and procedures contained in the Second Chance IRBS, along with significant changes that are consistent with the Fair Hiring and Banking Act amendments to Section 205D and the FDIC's comparable implementing regulations. The proposed rule addresses, among other topics, the individuals and types of offenses covered by Section 205D, as well as the NCUA's procedures for reviewing a consent application. Once finalized, Part 752 will supersede the Second Chance IRBS, and the current IRBS will be revoked. Additionally, the proposal makes several conforming amendments, as well as minor changes to Section 701.14, which is our regulation addressing changes in an official or officer in credit unions that are newly chartered or in troubled condition, to clarify when a notice is required, how the NCUA would process the notice, and what information must be included in any notice of disapproval. We are issuing the proposal for a 60-day comment period and seeking input on all aspects of the proposed rule and its approach to Section 205D and the Fair Hiring Banking Act amendments. The notice of proposed rulemaking also asks a series of specific questions for which we're particularly interested, and we would appreciate the public's input. At this time, I'd be happy to answer your questions.
Thank you so much, Pamela, for your presentation and for your strong work on this proposed rule. Thanks also to my colleague, Board Member Hood, for his leadership over the years on this very important issue. When he chaired the NCUA board, we approved a second chance interpretive ruling and policy statement in 2019. That guidance provided individuals convicted of minor and nonviolent criminal offenses with greater opportunities to work within the credit union industry. As Board Member Hood stated when we approved that policy statement, expanding career opportunities for those who have taken responsibility for past indiscretions is inconsistent with our nation's redemptive spirit. I fully agree with that sentiment, and I thank you for your foresight in being ahead of Congress on this issue. And you know, we've all made mistakes at one time or another, including me. But far too many Americans still face hiring barriers due to criminal records resulting from those transgressions. In fact, more than 77 million people in the United States have an arrest or a conviction record that could appear in an employment background check. Many of these individuals are not violent or career criminals. They are people who made poor choices at some point and who have since repaid their debts to society. Once more, a disproportionate number of these individuals come from communities of color. If we are to advance financial inclusion and equity within the credit union system, we must facilitate the access of all demographic groups to credit union employment opportunities. In 2022, Congress passed the Fair Hiring and Banking Act, which essentially codified several elements already found in the NCUA Second Chance policy statement, and it had a few more changes as well. This act also directed the NCUA to consult with the Federal Deposit Insurance Corporation on the implementation of the law. Following those conversations, the proposed rule before us is essentially a joint rulemaking. However, the NCUA's proposal does, as Pamela noted in her presentation, consider the different regulatory regimes that we have on the credit union side of the ledger and the bank side of the ledger. The proposed rule would add a new part, 752, to NCU's regulations. It would also codify the agency's policies and procedures related to consent applications. And the proposed rule would define what criminal offenses are covered by the regulation, such as those involving simple possession of controlled substances or other minor offenses. The proposed rule would amend the NCUA's rules governing the conditions under which newly chartered or troubled credit unions must notify the NCUA of proposed changes in their boards of directors, committee members, or senior executive staff. While I would support this rule, I do have a few questions for you. The first is, in this proposal, we talk about employees, but credit unions, especially smaller ones, are often run by volunteers. Also, directors serving on the boards of federal credit unions must be volunteers elected by their members. How would this proposed rule apply in those situations?
Yeah, sure. The proposal does cover volunteers, not just paid employees. I think we tend to refer to paid employees because we tend to get more applications for those. But yes, it covers volunteers as well. The statutory language in Section 205D is quite broad, so it refers to persons, so it doesn't refer, specifically to employees, for example. And then it prohibits those persons convicted of certain offenses from participating directly or indirectly in the conduct of the affairs of any insured credit union. So the scope of that language really does cover volunteers.
Yeah, so we're getting to the volunteers. That's important, and thank you for that clarification. My next question is about credit union insurance and fidelity bond coverage. Did we discuss this proposal with providers to identify if there could be any unintended consequences with these changes, including increased costs for director and officers insurance or increased costs for fidelity bonds?
So if I first just note that, under the proposed rule, individuals do have to be covered by a fidelity bond to the same extent as others in similar positions. So that fidelity bond coverage is already required under Part 713 of our regulations, and it's also consistent with our second chance IRPs. So there's no change there. In 2019, we did receive very helpful comments on our IRPs from credit union fidelity insurers, and at that time, those insurers indicated that they did not anticipate any immediate premium adjustments for credit unions due to the IRPs. And they expected that their bondability reviews would also continue to work largely the same. We would like to see comments about whether that remains true, and we would welcome any additional feedback as well on the potential impact on fidelity bond coverage.
Thank you. My last question is anticipatory in nature. What changes would we need to be made to the agency's guidance, delegations of authority, forms, and other processes to implement this proposed rule, assuming, of course, that we finalize it as proposed?
Right, of course. Yeah, assuming that the rule is finalized as we've proposed it, we would need to take a number of steps to implement the new requirements. So, for example, we'll need to rescind the second chance IRPs, as I mentioned. We need to provide guidance to prepare guidance for credit unions with information about how to apply and just more instruction. Update our delegations of authority, allowing our field offices to process the consent applications. Again, we'd have to revise all our forms, instructions, and then enhance our website to have those available as the act requires. It would also need sample documents and things like that that would be, easily accessible to the public. So we'll have to work on our website there. And then we'd identify any existing 205D notices that are no longer effective, and then we'd remove them from our website as well.
Great. Thank you so much for that, as well as the work of you and others on the team for this proposed rule. In working to provide access to financial services to people of modest means, credit unions should already be familiar with providing second chances, especially those credit unions that have worked with their members experiencing financial hardship. The proposed rule will allow credit unions to do the same now for their employees and teams. Providing second chances is consistent with the credit union's DNA and mission of meeting the credit and savings needs of people, especially those of modest means. That concludes my comments, and I turn it over now to the Vice Chairman.
Thanks, sir. Thank you, Pamela. And I appreciate the work you did to coordinate a bit with the FDIC on this. Pleased to see this proposed rule. My colleague, Mr. Hood, mentioned the difficulty in hiring cybersecurity experts. That's one field of many. And Mr. Chairman Harper mention the portion of Americans that have some sort of criminal record that would have come up on a common background check. Right or wrong, those are higher numbers than in other countries. So the pool of labor that we are allowing credit union management to look at with this is a larger pool than it would be in a similar rule in another country, just the way it is. Folks who have paid their debt to society or those whose offenses were relatively minor represent a big pool of workers. This proposed rule gives greater latitude for a credit union to hire an individual that may have a record or without them to serve on the board of directors. It carves out lesser offenses and expands on exceptions. The key is it narrows the instances where a credit union needs to apply to this agency, NCUA, to hire a candidate. And I want to say this is in line with my general philosophy. It's very difficult for us to hold a credit union CEO responsible for the performance of their credit union if we are interfering in their private life. And I use the term private life, who you hire, who you get paid, who pays you, that is your private life, at least it is in this country. And so we're not saying you can or should hire anybody. We're saying we're all grown-ups here. We're fighting this. Credit union management is responsible and no one else for what happens. It is just because, as we know, when we say you had to apply to NCUA to hire somebody, it's not like they were applying and they were getting yes or no's. In most cases, you just don't bother applying. As I said earlier, credit unions are one of the original answers to financial inclusion. So it's appropriate that we consider who might be excluded from serving either as an employee or board member. From the employee side of the equation, it gives more chance to get gainfully employed in the credit union. And it's an industry where inclusion is the core of its existence. This is good for them, their family, society in general. The rule also reduces the burden by shrinking the instances where the credit union has to apply to NCUA. There are still some, correct Pamela, where you do have, there are some criminal activity records where you still have to apply to NCUA, right?
Yes.
Okay.
Certainly.
We have just reduced that and expanded the pool of labor for credit unions and expanded the opportunity for those who want to work at a credit union. So the reporting requirements and deadlines in this proposed rule are current with our consistent policy. There are no additional compliance and paperwork requirements of credit unions out there. This also reduces the resources needed to investigate those applications from outside of things. And for the cases where you still have to apply to NCUA, like you said, for criminal offenses, we can focus on those and not the others. The availability of forms and instructions related to consent applications on the agency's website makes it easier to figure out who your potential candidates are. As said earlier, applicants will still qualify for fidelity bond coverage. I will be supporting this proposed rule, and I look forward to reading the comments from stakeholders. Question or two here. The rule sets out procedures when hiring somebody with a record, certain criminal offenses. Are these procedures that credit unions have to do, or are these procedures for NCUA?
So the proposal transparently sets out the procedures for both credit unions looking to hire someone with a record of covered offenses and also for the agency in reviewing an application for board consent. So consent applicants, reading the rule will know what information they need to submit, and they will know how the agency will review and consider their application. So that's all set out in the rule. The new provisions on consent application procedures are, as you said, largely in line with our existing procedures, but again, with some enhancements. Like, as I mentioned, the requirement for the agency to rely primarily on the FBI rap sheet, and that extra sort of level of review for denials that it needs to go to OGC, and there be the opportunity for, central office review of that. So generally, again, it would codify what we already have, but I think that, under the proposed rule, there's certainly going to be individuals with prior convictions, particularly those with expunged, older, lesser, de minimis offenses. Those are all, going to have an expanded opportunity, and we anticipate that there will be better career opportunities for those types of individuals who do have a record, but would like to work in or serve a credit union.
Excellent answer, very thorough. And last one, we're talking about credit unions and who they hire. The chartering process where the credit union doesn't exist yet, but has potential board members and potential employees. Does this apply to them too?
So Section 205D prohibition only applies to existing insured credit unions. As I said earlier, the language is insured credit unions. So that would only apply to existing, not new charter applicants. There are separate provisions in the Federal Credit Union Act, namely Section 1754 for new charters and Section 1781 for new insurance, and those apply in the chartering process and have a different scope and legal standard. So in chartering of new credit unions, CURE, for example, will do its review under Sections 1754 and 1781 to evaluate the general character and fitness of the proposed subscribers and management for the charter applicant. But once an approved applicant receives its charter and insurance, that newly chartered credit union would then go to its region if for processing a consent application if that becomes necessary.
Thank you for that, Pamela. Thank you for your work on this. Back to Chairman Harper.
Thank you so much. Board Member Hood.
Great. Thank you, Pamela, for joining us today and for all your hard work on this proposed rule. I'd like to begin by expressing my appreciation to Chairman Harper for presenting this matter before the board and doing so, you all, in an open meeting format rather than through a notation vote. As a member of the NCUA board, my primary responsibility is to safeguard the safety and soundness of the credit union system. Yet, where appropriate, and as I've said on numerous occasions, I believe it's essential for regulators to look for ways to better address the needs of the credit union industry and the local communities in which they serve. In this regard, I previously championed the Second Chance IRPs, which you've already heard about, which we considered in 2019 during my tenure as chairman. I am indeed delighted to see this notice of proposed rulemaking aimed at codifying many of the provisions we introduced in that statement. As many as 1 in 3 Americans carry some form of a criminal record. However, a significant portion of these individuals pose minimal risk to our society. However, having faithfully paid their debts to society, many of these individuals continue to confront barriers to securing gainful employment and to provide a positive economic impact on their local communities. This sadly perpetuates a cycle of underemployment, depriving them of economic mobility, financial access, and shared prosperity. I know the chairman mentioned that this does deleteriously impact minority communities, but also it's disabled communities that are impacted as well. Sure. It's a lot of it stemming from the intersectionality between disabled and communities of color. So it really does impact a number of folks. As I've often said, these individuals represent an untapped economic resource, especially in today's competitive labor market, where it's become really difficult for employers to find available candidates. Nevertheless, many individuals still struggle to find employment, even after taking responsibility for past indiscretions. Regrettably, hiring practices often lack compassion, leading to the rejection of otherwise qualified applicants based on long ago convictions for minor offenses. This proposed rule, I dare say, will remove that stigma. Hester Prynne no longer has to wear the scarlet letter. You all remember Hawthorne's scarlet letter from our high school days. One of the core tenets of our national identity is the belief that America offers a second chance, a place where individuals can make a fresh start. The proposed rule before us today, again, will do just that. It provides further regulatory relief that was introduced by the Second Chance IRPs through expanding the exceptions to the employment restrictions under Section 205D of the Federal Credit Union Act, excluding expunged and sealed offenses, reducing restrictions on old misdemeanor convictions and on convictions involving controlled substance possession. This proposed rule under consideration today represents more than just regulatory relief. It embodies a commitment to doing what is morally right. I have a few questions. Pam, you mentioned during your remarks that this NPR codifies many of the elements of IRPS 19-1. For people to understand any differences that exist, can you explain the main difference between the NPR and the Second Chance IRPs we introduced a few years ago?
Sure. Yeah, I'd be happy to go into more detail on some of the things that we've been talking about in terms of the expansion of relief that's going to be available under this proposal. So first, under the IRPs, you mentioned expunged criminal records So in some cases, they are still accessible to be used for subsequent purposes, like an evaluation of a person's fitness or character. And so those under the second chance IRPs would still require a consent application. But under the proposed rule, there's explicit relief with respect to expunged records. So even if they're still accessible for, certain character or fitness evaluation purposes, those will still be provided with relief. Second, the proposal would expand upon our current criteria for example, de minimis bad checks. So we already have that under our second chance IRPs, but it's limited to an aggregate total value, face value of $1,000 or less. So we're seeing an expansion under the proposal, which would allow for an aggregate value of bad checks to be $2,000 or less. So double. And also our current IRPs already includes de minimis exceptions for small dollar simple theft, the use of fake ID, but the proposal also extends relief to other designated lesser offenses, as I mentioned, like trespass, fare evasion, driving that expired. Those are very, low risk offenses that are now statutorily excluded from the scope of 205D. The drug-related relief is also notable. The proposal expressly excludes from the definition of criminal offense involving dishonesty. It just carves out entirely misdemeanor criminal offenses committed more than a year before the filing date of a consent application. And then, of course, also the offenses involving possession of controlled substances. So under the second chance IRPs, we already classify as de minimis convictions for simple misdemeanor drug possession offenses, but there's certain limiting conditions to that. And it's only if the conviction didn't involve, distribution, sale, trafficking, manufacturing. So the proposed rule should really provide more relief with that, with that carve out from the definition for more individuals with the drug possession related offense. And then finally, I would just highlight that the proposal does address foreign convictions, which our current second chance IRPs is silent on. We've proposed an approach to foreign convictions that's consistent with the FDIC's existing approach to these types of offenses, but the statute is also silent on this. So we are specifically asking for comment on that aspect of the rule.
Very good, and thank you again for all your hard work. And I just have one final question. I know we had a lot of valuable information in the second chance IRPs that credit unions should know and find very helpful. If this rule is adopted and it becomes final, are we planning on providing any additional guidance about Section 205D separate from the rule to maintain the information we introduced in the IRPs?
Yeah, we are. As I mentioned, in response to Chairman Harper, we are planning some implementation steps, assuming that the rule is finalized. So the proposed rule, as I said, closely mirrors the FDIC regulation, and that's required by statute. But there are a few areas in which the second chance IRPs provided additional context and discussion on our policy and procedures. And a lot of those, in fact, were in response to, questions we've had over the years or, public comments that we received on that IRPs. So the proposal omits a lot of that sort of clarifying information from the IRPs, and that was just really to ensure, consistency with the FDIC. But it's helpful information. So, credit unions sometimes have limited experience with this prohibition. Typically smaller, typically fewer resources. So all this additional guidance, I think, would be helpful to credit unions in complying with Section 205. So when we finalize, assuming it's finalized as proposed, and we move into the implementation, we do plan to, prepare guidance that incorporates all of those things that were sort of omitted from the proposed rule that are in the second chance IRPs.
Very well. Again, thank you and for all your hard work, and I'll wholeheartedly support this notice of proposed rulemaking. Thank you.
Thank you so much, Board Member Hood. Is there a motion?
Yes, Mr. Chairman, I move that the board approve proposed rule part 701, 741, 746, 748, and 752 of NCUA's rules and regulations for a 60-day comment period as attached to the board action memorandum.
Is there a second?
I second the motion.
There is a sufficient second. All those in favor say aye.
Aye.
Aye. All those opposed say nay. The ayes have it, and the motion passes 3-0. Before we close our board meeting today, I know that all three of us would like to recognize the work of H. Lenwood Brooks V, the former NCUA Chief of Staff and current Senior Policy Advisor to Board Member Hood. Lenwood will end his NCUA service in the coming days and begin a new professional adventure with the Federal Home Loan Bank of Dallas. Board Member Hood, as Lenwood has worked for you directly for the last 4.5 years, I'm going to break with the standard procedure and ask that you speak first.
Great. Well, thank you very much, Mr. Chairman. Tenacious, mission-focused, resilient, unflappable, indefatigable, professional, and most importantly, friend. These are all of the adjectives, and I could, in fact, keep us here much longer by just describing Lenwood Brooks and what he's meant to me as serving in many facets here. In fact, he was first hired with what we called PACA at the time, and now the Office of External Affairs and Communication, where he ran that group before becoming my Chief of Staff and then present-day Senior Policy Advisor. Lenwood has exemplified all of the tenets, I think, of people helping people. He has really gone the extra mile to really provide me with the necessary guidance and insight into being really an informed policy maker. Lenwood came to our agency having had stints working with Senator Dennis Wicker from Mississippi and also working with Wall Street's trade agency, SIFMA, the Securities Industry Financial Management Association. All of those activities, you all, allowed him to hit the ground running here, where he was able to serve in whatever opportunity we put before him. He served with great aplomb and great success. He really helped me a lot during the days of the pandemic. Remember when we were all really having to work to ensure that we had all the ingredients for a remote work posture, making sure that all of our employees were safe and sound, convening meetings with me and all of our senior leaders every morning during those first few months at 8 o'clock every morning. I think you will find that he really did help us seamlessly with that exercise. Also helping, we were negotiating the CARES Act with folks from the Senate Banking Committee. What many of you may not know is a lot of those negotiations for the CARES Act, we were up on the phones till about midnight on that Saturday. Sunday, those talks resumed again, and it was Lenwood putting me directly on the phone with Senate Banking when we were looking at the Central Liquidity Facility, when we were trying to negotiate maximizing our borrowing authority. You know, it had always stayed at 12 times that authority where we could borrow. Well, folks at the Senate, I wanted to pursue 18 to 20% borrowing, and they came back with 14 again, and I said no, so we settled on 16, but that was Lenwood really helping behind the scenes to really champion that for us. Also, we're creating our new Office of Government Ethics. As you know, that used to be embedded within the Office of the General Counsel. We now have a really strong, best-in-class OGE office. Also helping bring to fruition the Office of Financial Innovation and Access, and also the proposal and the rulemaking that we just implemented a short time ago. I don't want to give the litany of everything that he's done, but I want you to know that he played such an impactful role in helping me, whether I was chairman or board member. The one thing that I will say that many of you may not know is that when we would travel, he would go to events, many of the town halls and events. He would meet with any of the individuals that asked a question that required follow-up. He would then take copious notes, and many of you, I'm sure, have been the recipient of some of those email messages where he wanted to follow up around an examination question, the status of a de novo institution, any number of things. And some instances, he was so laser-like in getting to the bottom line of results. We would communicate back to that credit union while the conference was still occurring, and they were often just mesmerized at his ability to see things through their eyes, to really look at the end result. And a lot of that came from his, I would say, mission focus of our agency, recognizing that we are all self-funded. We are a self-funded agency, so he took it very seriously when there were concerns with our stakeholders, and he wanted them to get that level of what I would call that consumer-centric vision. So Lenwood would be hard to replace, but he will be greatly missed. And yes, as the chairman mentioned, he will be going to the Federal Home Loan Bank of Dallas, where he'll be their head of government relations and external affairs. And just like the credit union system that we all are a part of today, you all know that the Federal Home Loan Bank is a cooperative system as well. So he will still be within the cooperative system. And more importantly, he'll still be engaging with a lot of the credit unions there in his new task. So you will be greatly missed, and we thank you well. So onward and upward, Mr. H. Lenwood Brooks V, and thank you.
There you go. Thank you so much for those heartfelt accurate and extremely thoughtful comments. I too have enjoyed working with Lenwood over the years, and he navigated us through some difficult and thorny issues, and he has accomplished much. As noted earlier, during the COVID-19 pandemic, I greatly appreciated Lenwood's leadership, especially in working to get Congress to adopt the temporary enhancements for the central liquidity facility. Moreover, much of what we knew about how we worked changed overnight during the pandemic, and then worked many long hours to ensure that the agency continued to achieve its core mission while also protecting the health and safety of our workforce and contractors. Additionally, early in his tenure, Lenwood worked to right-size and restructure the NCUA's Office of External Affairs and Communications, which has improved our ability to interact with external parties. And Lenwood has been an effective advocate and voice for board memberhood in inter-office negotiations. I know this doesn't get said enough, but the people who really get the work done are not the three of us on the board. They're the senior policy advisors. They're Lenwood Brooks, they're Sarah Bang, and they are, of course, Catherine Galicia. They're the ones who have to talk to each other because we're not allowed to talk to each other on policy under the Sunshine Act. So you did a very well job done. And then finally, Lenwood, one thing I will say about you, and we've had these discussions, what I've appreciated about your time here is watching you grow to become an even more inclusive leader. And I think that that's going to help you tremendously in your new opportunity. So Lenwood, I wish you well, and I hope that our professional paths will continue to cross. And before I recognize the Vice Chairman, I do also want to welcome aboard Nagi Khaled, who will serve as the Acting Senior Policy Advisor for board memberhood in the interim. Nagi is a rising star on the NCUA career staff. Most recently, he significantly contributed to the development and adoption of the NCUA's Financial Innovation Rule at last month's NCUA board meeting. Catherine, Elizabeth, and I all look forward to working with you in this new capacity during your detail. That concludes my remarks. Vice Chairman.
Thank you, Mr. Chairman, for the opportunity to speak about my old friend Lenwood Brooks. Also impressed, you managed in this to shoehorn a plug for the central liquidity facility. That's amazing. I was an admirer of Rodney Hood's work on this board before I got here, and Rodney's work as chairman, and I think we all agree, my compliments and admiration for Rodney Hood. A big chunk of that is admiration for Lenwood Brooks and the work he did. Lenwood and I were friends before either one of us worked at NCUA. I thank him now for the instrumental, and I don't use the word lightly, instrumental work during my confirmation process 3 years ago. Lenwood, I look forward to seeing your many accomplishments at the FHLB in Dallas. I envy your lack of state income tax. and I will miss you as a colleague and most importantly as a longtime friend.
And I too want to welcome Nagi to our team as well. So Nagi, we look forward to working with you and welcome. You're that next generation of NCUA leaders, and we look forward to working with you in partnership in the days ahead.
Absolutely. I think it's appropriate, although it isn't necessarily protocol, for us to recognize Lenwood with a round of applause.
Exactly. Here, here.
Thank you, everyone, for your comments and for your hard work today. That is the end of our agenda. There being no further business, we are hereby adjourned.